All right, let's dive right into this explainer. We are taking the standard, honestly, kind of dry tax compliance manual and turning it into a high-stakes, level-up survival guide. Because look, if you're navigating the tax world right now, you know that the line between a tiny hiccup and a full-blown IRS audit, yeah, it usually comes down to precision. So today, we're going to lock that precision in. Here's our map for today. We're going from junior-level fundamentals all the way up to director-level complexities. We'll hit the foundational glossary, navigate some common tax traps, tackle advanced multi-state and international issues, and finally, wrap it all up with the period-end checklist to keep your compliance absolutely bulletproof. All right, part 1, the foundational tax glossary. Let's build that foundation with a few commonly confused terms that you literally need to know with absolute precision. Gross income. This is the absolute starting point on any return. It's the broadest measure of income before you touch anything else. Essentially, it captures everything your client brings in from any source. Unless the law specifically points to it and says, hey, that's excluded, it goes in. And if you don't get this number right on day one, the rest of the return is already messed up. Then we have adjusted gross income, or AGI. Now, this isn't just some random calculation. It is the critical subtotal. You take that broad gross income and subtract specific above-the-line deductions. Why does this matter so much? Because AGI is the gatekeeper. It literally dictates whether your client is eligible for a whole bunch of other deductions and credits further down the line. And finally, we land on taxable income. So that's your gross income minus all applicable deductions, like the standard or itemized ones. This is it, the actual final number that the tax rates get applied to. The golden rule here? Gross income, AGI, and taxable income are three completely different numbers on the exact same return. Never mix them up. Now let's look at one of the biggest sources of client confusion, marginal versus effective tax rates. Look, the marginal rate only applies to the very last dollar earned. It's the top bracket they hit. But the effective rate, that's their total tax paid divided by their total income. It's always lower. So when a client is panicking about their tax bracket, you got to remind them the effective rate is the only number they actually need to care about. To put the sheer scale of the exemptions we're dealing with right now into perspective, look at this number. $13.61 million. That is the massive 2024 estate and gift tax exemption. An exemption is just an amount completely excluded from income, and while most personal exemptions vanished a few years ago, this one is still a massive planning opportunity for your high net worth clients. And on the corporate side, check out the $1 billion threshold. That's the average annual book income required to trigger the 15% Corporate Alternative Minimum Tax, or CAMT. The AMT is basically a parallel tax system. It's just there to make sure that super high-income taxpayers, whether that's individuals or massive corporations, are paying at least a minimum baseline amount. Moving on to part 2, navigating common tax traps. Let's see how these basic terms turn into major landmines as you level up in your career. I like to call this the minefield. You can see how the errors escalate as you move up the ranks. We go from pretty basic rate confusion at the junior level all the way up to some truly massive international compliance risks for directors. Let's break a few of these down. For the juniors out there are two huge traps. First, never tell a client your tax rate is X% without clarifying if it's marginal or effective. If you tell them they're in the 37% bracket, they will freak out, even though their effective rate is probably closer to 25%. Second, state taxes. Federal is only half the battle. You absolutely have to identify every single state where that client operates or lives. As you move up to senior, the mistakes get way more expensive. Seniors have to check the actual federal returns to figure out entity classification. Do not just look at a legal name. An LLC is a total chameleon. It could be a C Corp, an S Corp, a partnership, or disregarded, all depending on the elections. Oh, and seniors, you also need to be actively planning for the TCJA sunset. And speaking of that, the clock is literally ticking on the Tax Cuts and Jobs Act of 2017. 2024 is your critical planning window, because in 2025, a ton of individual provisions are set to just vanish. Any long-term planning you're doing right now has to account for potential rate reversions, a drop in standard deductions, and the slashing of those massive estate exemptions we talked about. All right, part 3, advanced, multi-state, and international. Time to step up the complexity and enter heavy-hitter territory. At the manager level, you need a hyper-awareness of multi-state nexus. You don't need a giant new headquarters to trigger tax obligations in another state anymore.
Hiring literally one remote employee, storing a little inventory in a third-party warehouse, or just hitting 100 grand in sales in a new state, that instantly triggers income, sales, and payroll tax registrations.
And for directors, you have to flag international dimensions super early. These are not just niche issues for Fortune 500s anymore. If your client has a foreign bank account that hits just over $10,000 for even one day, boom, FBAR filing triggered. If you miss that or overlook things like FATCA or JLT, you're looking at remediation work. And trust me, remediation is vastly more expensive and painful than just planning for it.
Which brings us to Part 4, the period end checklist. How do we actually survive this minefield? We use our shield. By methodically running through these 4 steps during every single client review, you lock down your compliance and eliminate blind spots. You ID the entity, verify the federal income, audit the payroll, and do a final sweep for state and local stuff. Let's zoom in on a couple of these.
Step 2, federal execution. This requires strict verification. You've got to make sure all gross income sources are fully documented. Confirm those deductions and guarantee that the quarterly estimated payments actually satisfy the federal safe harbor so you don't get hit with underpayment penalties. And hey, if they're a C-Corp, just double-check you're applying that 21% flat rate.
When we hit the payroll phase in Step 3, we run into a really critical distinction: W-2 versus 1099 NEC. W-2s are for your employees, where you withhold taxes. The 1099 NEC is for non-employee compensation, so independent contractors paid more than $600. Knowing the exact difference here leads us straight to the ultimate boss battle of tax audits.
Pay really close attention to this. Here's the trap: classifying a worker as a 1099 independent contractor when legally they should be a W-2 employee. This is easily one of the highest audit risks a client can take. It is heavily scrutinized by the IRS federally and by state labor agencies.
You can't just guess here or take your client's word for it. You have to evaluate any new worker against the specific test used in your jurisdiction. The IRS might use the common law test, sure, but a lot of states use the incredibly strict ABC test. You have to know exactly which rules apply and be able to prove your client meets them.
Which leaves us with a critical question to ask yourself today. Think about your current client roster. If the state or the IRS knocked on the door tomorrow morning, are you absolutely 100% certain every single one of their 1099 contractors would survive the scrutiny of the ABC test? Because if there's even a shadow of a doubt, well, you know what to do. It's time to open up that checklist again.